Okay, so read this disclaimer first, please, guys. The clue's in the name of the channel. I'm an amateur, and I'm actually pretty bad. So nothing in this video should be taken as financial advice. Don't act on anything. There could well be errors, there could be slips of the tongue, anything. Do your own research, seek your own professional advice. Don't listen to me.
Hello there, guys. So just the last little bit of the portfolio to explain to you. Should be a short one. I've said that every time and it's always ended up being too long. Okay, so basically it's called the momentum section of my portfolio. So this is something that happened, God knows when. When was this? This article inspired this little section of my portfolio. I think different versions of this article turned up on different websites. When was it? October 2015. So the principle is, it's called the Bonkers Portfolio. It says it's returned 3,000% in 20 years. Basically, all it does is it buys the best performing fund. These are open-ended funds, by the way. Over the past 6 months, you buy the best performing one of those, which has to be greater than 50 million in size, as it says there. So the theory is, if something's done really well over 6 months, the chances are it'll continue to do quite well over the 6 months after. And they've back tested it 20 years from 1995 to 15. Here's the chart of it going up. Lots of volatility, as you can see. I mean, in the article they say I wouldn't do this because it's crazy. But I mean, I don't know why they. In the article, they're going from the perspective of, I wouldn't put all of my money in this strategy. But so what I've done is just put a little bit of my money in the strategy. Really, kind of just for the fun of it, really. But I haven't just followed the strategy. What I've done is, they say just buy the one fund which has done the best over the 6 months. What I've modified this strategy slightly to go into, well, as you can see in this year I actually went into 4, but I kind of honed the strategy down to 2. The top 2 funds over the 6 months in different sectors. So if the top, obviously when gold was at the top of the leaderboard for 6 months, it's normally about 5 or 6 gold funds at the top of the fund of the leaderboard when I'm checking which are the best 6 months performance. So I go to 2 different sectors, and I also don't allow myself to stay in the same sector for 2 6-month periods on the trot, because these things could easily just be bubbles that are waiting to burst, and 6 months might be a little bit dangerous to stay in for the bubble to burst. But I feel like a year staying in the same fund or the same sector is a bit too dangerous. You know, you're risking your luck a bit too much of whatever bubble that might exist bursting is. So just for my peace of mind, I go into 2 different sectors instead of 1, and I don't go in 2 sectors at the same time. Now, one of the things I'd just like to mention in this article, one of the things it says is, there's a little thing here, it says, a great portion of the gains would have come in the past 4 years, i.e. 2011 to 2015, during which time the portfolio grew around 2,000%. I just want to question that, really, because of course the last 4 years is where most of your percentage gain is going to come, because that's how compounding works. Any percentage gain you make in 1 year is actually applied to all of the percentage gains you've made in every year before. So of course it works out like that. So what I did was I just did I've got a little spreadsheet here that calculates the annual return based on start price, the end price, and the number of years, which can be a decimal. And what I've done here is 95 to 05. I mean, I haven't got the full data, so I've just had to guesstimate it, really. So 95 is 0. So I've put the start price as 100. So you had £100 perhaps in this imaginary fund. So I've started at 100, and then I've guessed for September 05 is pretty lucky because it's right on 1,000. So if you had 100 pence in the fund, that would turn the 100 pence into 1,100 pence, because it's 1,000 times what you started with plus what you started with, and that's a 10-year period. So here's a little formula, by the way, that calculates that. So over the first 10 years, it calculates it as 27.1% a year return. And then the second, I've done a similar thing. I've estimated based on the numbers on the graph. I estimate that the second 10 years was 11.27%. But then, so for the 4 years they're talking about, so obviously 05 to 15 hasn't done quite as well, but it's still pretty good, 11%. So actually the last 4 years that they're talking about has done no better than the first 10 years. So I think, I mean, the people writing this article should be more savvy than this. They should realise that compounding, if you had a 10% increase every year, it would always curve up exponentially like this graph does. That's how compounding works. What was it? How many wonders of the world are there? Einstein said it's the n+1 wonder of the world, didn't he? Okay, anyway, that's just my little moan about that sentence in the article. So how's it done? I've kept track of this separately. I don't normally do this, but so what I've done here is I've put the dates that I buy. Oh yeah, by the way, it's you buy it on the first. Well, it's the end of March to the end of September is what they tell the date they tend to tell you to buy and sell on. So I normally end up selling it on the 31st of March or as close to it as I can get, and then buying as soon as I can on the 1st of March. But obviously, it takes time to buy and sell the funds. So sometimes sometimes weekends occur. So it's, it's just as close as I can get, really. So as you can see, the first year, this was the best year I've had. I went into a gold fund and a Japanese fund, and in the first 6 months it made 27%. So on an annualised basis, that was making 62.1%. So it's got off to a good start, so that's always helping. This, by the way, is calculating the annualised returns from that time point all the way back to that time point. It's using the number of years here, year 0 to 0.51, 1.52. So obviously that got off to a cracking start, and I see the annualised returns. The next one was I went into 4 before I'd honed my kind of strategy, really. 4 different funds, and it made 7% which reduced heavily, so 37% in the first year. Into European stocks and UK smaller stocks, it made that's really good, 18% and then 17%. And a bad couple of periods here where it was just barely up by 1%, and then it was down by 9%. Good one last time, and then now that's not quite up to date, I don't think. I think I've got the numbers here. 1.3% down now I am, so just update that number. 1.3% down. Oh, sorry, minus 1.3. So as you can see, we're down a bit at the moment for this period. So overall, it's been averaging 19.7% at the moment, which is really good. But obviously, the same with all these investments. It'll have really bad periods. Look at that. Doesn't look that bad on this graph, you see. When you expand out over the long term, these drops don't look that bad because we know that it's gone high up here. But actually, if you look at, say if that's 1,600 is there on my kind of starting at 100. 1,600, maybe that's 1,700, and it's gone down to, I don't know, it's hard to decipher. It's down to 750% up, which is 850. So 1,700 to 850. Whoops. Very rough numbers, these. That's down 800. Oh, that's exactly half, isn't it? So even though it doesn't feel that bad, knowing what happens afterwards, that is actually a halving. But to be fair, the whole market halved from 07 to 09 or whatever it was. So this has actually done no worse than, in volatility terms, in this big bad period, it's done no worse than the overall market. So the big question, if it continues to do this well, I'll stick through the bad times like I stuck through these bad times here. If I'd sort of given up on the strategy here, I wouldn't have got this, would I? Because actually from 191 to 207 it's up. It doesn't matter that I had a bad period. And actually this bad period, at one stage during the 6 months, it was down about 20%. So, volatility, you've got to live with it. Or I don't mind living with it. It's at the moment, what is it now? Percentage of portfolio. again, this includes the cash. So about 5% of the portfolio. It only really started at about 3% of the portfolio, I think, something like that. So even though, that 5% is actually, doesn't feel like 5% because of the amount I've put into it, because it's done better than all the other sectors of my portfolio. As I've said before, this isn't enough for me to live on 11 grand or 12 grand, sorry. So I will have to sell capital. On the good year, when this makes money, this will probably be the first place I take my spends from if it makes a profit. Kind of because I'm always selling every 6 months. I'm selling anyway. So just like admin wise, it's easier to just take the money from that sector of the portfolio. Also, it's probably one of the most risky parts of my portfolio because it's, I don't know, sometimes it sends you in some crazy places, like one specific country, a fund that goes in one specific country. I feel like that's more likely to have a massive upset than a global fund like Fundsmith, which is growth, has an equally, well not equally, it has a slightly higher yield, because obviously this doesn't pay any income. I mean, sometimes it will go into income paying funds, but I'm not treating it like that. I'm treating this as a purely capital growth. Finding which funds to go into is a little bit tricky. There was another website that did this, that kind of did this, but at the moment I've ended up having to use Hargreaves Lansdown's website, and it's a bit tricky because what I have to do is, you have to go through, I don't know why the website's like this, but you can't just get one table of all the funds. It only seems to do it sector by sector. So here's a little table, and you click on the 6 month, and that's probably going to reverse. Yeah, so it's reversed it. Click it again, and it'll put the best performer over the 6 months at the top of the list. And 11% is not normally high enough, so I'll ignore that one for now. And I just click through. Oh, so for some reason the first time you change it, it loses the fact you want it ordered by 6 months. But the second time, hopefully from now on I shouldn't have to reorder it. Yeah, see, now it's ordering it by the 6 month performance. So you just go through the list, copy, paste, oops, just pressed V instead of paste, Control V, resize all these things so they look better. And just keep going through the groups. Normally takes me about 10 minutes maybe. I don't know, I've never actually estimated it, I've never actually measured it. And just all the high numbers, if it's obviously very low for that whole sector, I don't have to bother copying it over. I'll just go through all of them. And then once I've got a list, so pretend I've gone through all the sectors. I don't know how many sectors there are, but there they all are. I'll just click through. Luckily, Word makes it Excel makes it easy because you just click there. It does take a while though, and it links you through to the fund. Keep clicking the wrong places. Largest to smallest is what I want. I forgot to click. Anyway, you can sort this column first, and then just go through the top of the list one by one, and you can check here the fund size. That's plenty big enough, so that meets the criteria of 50 million or more. Actually, I've changed the criteria because that was in 2015. I've actually gone for 80 million or more, just for inflation. At some point, I'll probably go to 100 million or more as the criteria, and then just click into them. And eventually I'll end up with two things that are in different sectors, and at the end of March or the end of September I'll sell the other one and buy the new one in equal amounts. This third one is called Momentum Ad Hoc. Basically I kind of loosen the rules. Every now and again, there's no timing specified, every now and again I'll just go through the list and see how it's doing. I'll see how my current ad hoc one is doing. My current ad hoc one is there, Fidelity Global Technology, 4.36%. And every now and again I update these numbers, and if I just feel like that's done well and it's had a good run, maybe I'll go through the list and see what's doing well at the moment. Maybe I'll sort it by 3 months. Basically I just do what I want with it. using generally momentum kind of thoughts, and it's a bit ad hoc. So far, it's not doing as well. It's only had small rises, I think. Yeah, there's like a 1% up, or there's a 3% up. Not as good as the other ones. I think the strategy works better when you give it time. You give it the 6 months to work. Anyway, so there we go. There's the momentum section of my portfolio. Alright, thanks for watching. Bye bye.